Hello and welcome to a special show of The Global View. My guest on the show is someone today whose word is considered to be the final word on Wall Street on market behavior. And if a pantheon of great investors is ever to be made, his name would be right there on the pedestal. Tanvir, whom are we talking about?
Howard Marks, and he's our special guest today on the special edition of The Global View. He's, of course, the founder of Oaktree Capital Management, which is one of the largest alternate investment management firms in the world with an AUM of nearly $100 billion. They invest in distressed debt, real estate, and listed equities. They would largely manage money on part of pension funds, endowment funds, and sovereign wealth funds across the world.
His memos are very popular, and he has simply endorsed a simple philosophy, which is you should buy fear and sell greed. Howard, what a delight and a pleasure to have you on ET Now. Thank you for joining us. Straight off, let me take a leaf out of your memo, and your memo reads, in the short term, markets merely reflect consensus opinion regarding an asset, something which is highly susceptible to ups and downs of psychology. So why do you think markets are not always right? Can you explore that? Can you throw more light on that?
Well, first of all, if we thought markets were always right, then we shouldn't be in this business. Because if the market price were right, then there would be no such thing as buying a bargain or selling an overpriced asset. So, number one, we have to believe. It's a prerequisite for our engagement in this business to believe that markets make mistakes. And the greatest market mistakes are driven by emotion, either too much greed or too much fear, too much optimism, too much pessimism, and not by analytical mistakes. And markets, groups of people are subject to mass hysteria. And so at the extremes, my experience of almost 50 years tells me that when things are going well, people get too excited and want to buy too much at prices that are too high. And when things are going badly, people get too depressed and want to sell too much at prices that are too low. And that doesn't mean that you can make money by buying every day the market goes down and selling every day the market goes up. It merely means that you should be alert to the errors of the crowd, especially at the extremes.
And that's a fair point, Howard. You know, another aspect that you highlight in your recent memo, and you talk about how the market does not have above average insight, but it often is above average in emotionality. Is that what we are seeing in the oil market right now? Just an over emotional market, which perhaps is steering away a bit from fundamentals?
Well, I would say that we don't actually know what's going on in the oil market because we know that the price of oil is set based on supply and demand, as it is with most things. By the way, we know that wasn't the case for the last 40 years. While OPEC was in charge, the price was an administered price. So we don't know whether any of the historic prices were fair indicators of what the price should be. Anyway, a year and a half ago, the price was over 100, and today it's 30 or so. But this is a price which we believe is set primarily by supply and demand. In the last couple of years, the demand for oil has slowed, especially as the growth in China has slowed. And the supply has increased as U.S. fracking has come online, and also maybe some of the Mideast nations are pumping more. Then we get into strategic or shall I say, political aspects. Historically, Saudi Arabia, it is believed, has adjusted its production to be the swing factor in order to keep the price of oil high. So when others would produce more, or if demand would dip, the Saudis would bring production down and in order to support the price. But everybody believes that a couple of years ago, Saudi said, we're tired of doing this. Why should we throw the party for everybody else, reduce our production to keep the prices high? We're just going to produce what we think is right to produce the amount of revenues we want. So the Saudis increased their production at the margin, and this depressed the price of oil. So I would say that these are supply and demand factors. The price of oil is not set as it is for stocks by hundreds or thousands or millions of people calling their brokers on a given day and say, buy General Motors, sell Ford. This is it's set, I would say, primarily by supply and demand. Now, then oil industry securities are then bought or sold by thousands or millions of investors, and it's quite possible that they take things too far, but based on an extrapolation and an exaggeration of the downtrend that has been affecting oil for the last year and a half.
Howard, 2016 is off to a horrible, terrible, and a pathetic start. Some are reacting to China, some are worried about oil. There is no consensus view on what Fed could do. So if the concerns are well documented and concerns are well known, why are markets reacting to old concerns currently?
Well, as I say, I believe, Nick, that it is emotion at work. You said an interesting thing. You said that all of these concerns are well known, well documented. Why is the market having such an emotional reaction to them? And the answer is because it's very hard to convert a set of fundamental conditions like we have now, China, oil, and so forth, into the right price for securities. So when things are looking bad, people exaggerate their import, in my opinion, and take the price too low, and vice versa on the upside. Now, an interesting thing is that you said uncertainty over oil. So, to use your words, the decline in the price of oil is one of the factors contributing to the decline in the securities markets in the beginning of 2016. But is the decline in the price of oil really a bad thing? Who's hurt by it? Oil companies are hurt by it. Oil service companies are hurt by it. And nations that are net producers of oil are hurt by it. But the rest of us should be helped by it. India doesn't have any oil production. You buy your oil. Low prices are a good thing for India. The U.S. has production, but it is still a net importer. Low prices are good for the United States. It's like a massive tax cut for the consumer. So why should falling oil prices be on the list of the factors contributing to the decline? It makes no sense. But when emotions rule the market, most things don't make any sense.
Right, and they don't. And the other aspect that is top of mind for investors right now, and you also highlight that in your both your recent memos, is about the comparison between what's happening now to what was happening in 2008. The housing market was pretty much the epicenter of the problem then. It seems like to the market and to investors and participants across the world that crude is the epicenter of the problem right now. Is that how you see the picture? I mean, how would you compare market participants, looking at the current situation with what happened in 2008?
Well, in 2008, you identified housing. We had massive excesses and errors. The whole basis for the subprime industry was fraudulent or at least fundamentally unsound. There's no comparable thing today. When you say, is oil the comparison, what is it about oil that makes it comparable? There's nothing, in my opinion, fraudulent or unsound going on with oil. It's merely a commodity that a bunch of people use, which is declining in price. But I don't see a comparison between now and 2008 in degree or in kind.
What is your assessment of China? The Chinese economy clearly is in in a transition phase. They are changing the mix of the way economy looked like in the past. So do you think markets are struggling to understand how the new China will look like? And do you think the nervousness around China is justified?
Well, I think markets are definitely struggling. First of all, China reported superhuman growth in their economy for the last 20 to 30 years. Now, believe it or not, China is no longer the cheapest place to manufacture in the world because the economy is moved into from undeveloped to developing. There is some inflation in wages, so they can't produce goods as cheaply as they used to. Other places are cheaper. They have to find other ways to grow. And so China, as you say, Nick, China is making a transition away from merely reliance on the movement of people from the farms to the cities, away from reliance on cheap exports, away from reliance on easy money contributing to a high rate of building, transitioning toward domestic consumption of goods and services. They're transitioning to a more normal growth rate, which in the future, if everything goes well, will probably be in the range of 6-7% a year. Still very high by world standards, but low relative to history. And by the way, they'll probably have recessions like everybody else. So the transition from the easy times to the difficult times to from certainty to doubt always produces weakness, and that's what we're going through with regard to China now.
Right, as they say, transitions are always painful. But Howard, one more quote from your memo. There's only one intelligent form of investing, you say. Figure out what something's worth and see if you can buy it at or below that price. It's all about value. You've raised a new fund, I think in December, and you're an investor in China. Do you see China emerging as a value trade just as yet?
We don't have much invested in China. We don't invest much in stocks at all, and we haven't done much in China so far. We've put a toe in. As you said in the introduction, one of our big asset classes is distressed debt. We've entered into one joint venture in China. We have to see how things go there, and in particular, we have to see how the system operates over there. Our success as distressed debt investors over the last 27 years has been based on the fact that if you lend a company money or buy a company's debt and the company doesn't pay its debts, then we can appropriate value from that company through a bankruptcy process, through foreclosure, if it's a mortgage, something like that. And that system works with extremely high reliability in the U.S., because of our bankruptcy system, with very high reliability in Canada and the UK, and after that, the reliability of that process declines. And we have to see through experience how the process will work in China before we know whether it's ripe for the things we do. 5 years ago, China was viewed as flawless. And I said in my memo on the couch, that investor psychology, in the real world, if you think about your day-to-day experience, things pretty much range from pretty good to not so hot. But in the investment world, people swing from flawless to hopeless. China was viewed as flawless 5 years ago, and now some people view it as hopeless. So the swing has been great, perhaps excessive. And when assets are being priced without much optimism, they're much more attractive to us than when they're viewed as flawless.
Let me again quote a Harvard Mark classic, which is, fear is overdone concern, and that prevents investors from taking constructive action when they should be participating. So in which asset class broadly do you think, sir, the fear is slightly overdone and one should be participating?
Well, I think we are transitioning ourselves. We went through I discussed China's transitions. The developed world markets, and especially the U.S. market, is now transitioning from a period of optimism, positive attitudes, risk tolerance, and let's say complacency, to a period of pessimism, fear, and risk aversion. That transition makes things much more attractive to us, but I think it has only begun. And in my memo on the couch, I said that our mantra for the last almost 5 years has been move forward, but with caution, with a heavy emphasis that everything we did in this period should be extremely cautious. And now I said, we're willing to be a little less cautious, a little less cautious. We're not saying back up the truck. We're not saying this is a massive buying opportunity like the fourth quarter of '08 after the Lehman bankruptcy, a little less cautious. So if you didn't have any investments, now you can have a few investments. If you had a few investments, you can have a few more investments. But this is not a time for aggressive movement, in our opinion, because it looks like fundamentals in the world may be getting worse, and attitudes have just begun to turn from positive to negative, and probably have further to go. So I am not calling this a time for massive buying.
And you know, on the couch, in that very memo, you spoke about between 2012 to 2014 the uncertainties that kept you worried. One of them was macro growth, and that is one ailing point for global market watchers, economy watchers at this point in time. That after 8 years of accommodative monetary policy, we haven't really seen conclusive and sustainable signs on economic recovery. And every time the word accommodative is used by any central bank, the markets cheer. How do you rationalize that market behavior, and how long will it last?
Well, I think that we humans get used to one kind of environment, and then we're kind of shocked when it changes. But I think change is natural. The point is that if you look at let's say the last half of the 20th century, we had the rebound from World War II, the emergence of the baby boom, massive gains in technology, productivity, managerial techniques, massive increase in the use of credit. And all of these things gave rise to a certain rate of growth in the world. I'm not an economist. My observations are usually low in data content. But let's say that the world grew at 3% a year in that period, or 3 plus. Now we're talking about 2. Largely because in much of the world, the birth rate has declined and the rate of increase in productivity has declined. And these two things together are the primary gross determinants of growth in GDP. So it appears, and I'm not an economist and I don't like to make sweeping statements, but it appears that we are and are going to be in a lower growth environment in the coming 10 years, 20 years, who knows how long it lasts, than we were in the 50 years in the latter half of the 20th century. And that introduces problems. In the developed world, how do we compete with the developing world in a globalized world? Number one. Number two, what job opportunities are there in the developed world for the less educated? Number three, if there aren't many job opportunities, how do we support them? How do we deal with the income inequality? What impact does the income inequality have on the political process? I think in the U.S., with the interest that people are expressing in Trump, Cruz, and Sanders, I think part of it is concern over income inequality and the future. Um, and then in the developing world, one of the reasons that developing nations grow rapidly is by serving a rapidly growing developed world and the appetites and hungers. And if the developed world grows more slowly, then the developing world will grow more slowly. It'll still grow faster than the developed world, but it'll have to be, as in the case of China, domestic consumption, growth of the middle class, rather than merely exporting goods to a fast-growing developed world. So I think this is the biggest single question. This is bigger than oil and bigger than interest rates, and it's a sweeping factor, and it's not going to be determined anytime soon. The outcome.
Howard, at a time when global growth is likely to be subpar and things are unlikely to blossom in the short term, do you think India is the only bright spot? Because now officially India is one of the fastest growing economy in the world, and we do have some inherent advantages, which is a large population and great demographics.
Yes, I don't know much about India. I've never been there. My plan is to remedy that within the next 12 months. We don't invest in India. I haven't studied India. I believe that India has a lot of potential. As you say, demographics, resources, educational system, and hopefully drive. And these are the elements that can make a country an above-average grower. Now, India has to become more efficient, and hope maybe in my visit I'll get an opportunity to conclude whether it will or not. But I have high hopes for it, and I would like to see these millions of people enjoy a better lifestyle through economic progress.
Howard, we would love to have you in India, so make your plans, and we're looking forward to the opportunity of hosting you right here in our homeland. But, I have heard you say earlier that you're a believer in emerging markets, and so far, the sound bites that we gather is that India has the potential to stand out among emerging markets. We've seen that with the macro environment in India, as Nikunj said, growth outlook. We've seen that with the currency, which has largely been resilient, and even with the equity markets here. Is that broadly your thought process too, that within emerging markets, if you're a believer there, within emerging market equities, that India has the potential to stand out?
Potential is a funny word. It's not exactly clear what it means. I would say it has the possibility.
Okay.
That's not certainty.
Okay.
But if it can get more efficient and reduce the red tape and behave like governmentally like a capitalist country, a free market country, I think India could have a great future.
So I won't get into today, tomorrow, this week, next week, this month, next month, this quarter, next quarter. Let me understand from you that 5 years from now, this is 2016, 2020 or 2015, if we are interacting on the same forum, hopefully in our Mumbai studio, what would the world look like?
I think the world in general, and I'm not talking about India specifically, or the emerging markets specifically, but I think the world will look less happy than it did in the 90s, but more happy than it looks today. I think that in the 90s, things went better, the fundamentals were better, and people were really happy. It was a period of good feeling. Now the fundamentals are going less well. I believe that people, to some extent, exaggerate or over-exaggerate the deterioration of the fundamentals. And today they're rather gloomy. So I think that 5 years from now we will probably have adjusted to life in a lower growth world, and hopefully there'll be less gloom. In the meantime, I think the gloom will have reached a higher level. We'll have had great times to buy, and hopefully we'll be sitting on some substantial profits by that time.
Yeah, that's what we are hoping as well, Howard. Also, perhaps, you've made a 5-year projection. Maybe 12 months down the line, we hope to see you in India. So that's a near-term plan you may have on your books.
Good. I hope to make it there. I'm very excited about coming.
Yeah, and we're very excited about having you. But thank you so very much for taking out the time to speak with us. It was great chatting with you and getting your exclusive views on the global turmoil, emerging markets, and India in specific. Nikunj?
So on behalf of entire team ET Now, Mr. Marks, I appreciate your time and thank you for accommodating this interview request.
Very good. I hope it's been productive for you.
Yes, thank you very much, sir. I look forward to see you much more.
Bye-bye.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.